week. I'm Barry Russell, your moderator and host, and there's going to be about an hour for our panel today. And I want to first of all thank Dan Lewig of the Insurance Store for handling the role of managing host. Before starting, I want to thank our sponsors, and we're going to play some slides here that will show who they are for their contribution to this being an event that takes place. First, our premier sponsors. I want to thank the Credit Law Center, which is an attorney-based credit repair, Russ Keller. The moving and storage sponsor, Simple Moves, Chris Giannino. The vacant staging services, Linda Borhe of Dazzle Home Staging. Certified Public Accountant John Brandvine of Brandvine and Company, Title, Insurance, and Closing, Chesterfield Title with Mimi Brandt as the new business development, and staging service Occupied, Andrea Lenson, Design Staging. Our event sponsors are John Drake of CNB Bank, Mariana Angelova of Motto Mortgage, Brad and Trish Langeneckert of Langeneckert Homes, Jim and Ryan Wessels of Three Doors, Nick Najar and Diane Collins of St. Louis Real Producers, Brian McCrae and his team, the McCrae Mortgage Team, Dennis Cooper, Reverse Mortgages, the Federal Savings Bank, Jim Colombo, St. Louis Painting Company, Knox Malis of Integrity Title Solutions, Dan Lewig of the Insurance Store, independent insurance broker, David Fox of Carpet Masters and other related companies, Andy Hickson, insurance broker, EFG Financial, Nathan Kerpen, mortgage professional, Benchmark Mortgage, Denise Reed, Paget Business Services, Jeanette Neely of Nothing Bundt Cakes, in 2 locations now, Troy Pieper, insurance agency of State Farm, Don Thurman of Concert Homes, and Deborah Russell with ID Shield and Legal Shield, and myself, Barry Russell, and Rod Hamilton of Short Sale Specialists. If you'd like to find out more information on our sponsors, please go to therealestatecollaborative.com as you saw on the screen. Well, this morning our topic is how top investors view the St. Louis real estate market during the COVID-19 crisis. Last month we had realtors commenting on how they viewed it, and this month we're having top investors and one lender as well comment on how the COVID-19 crisis is hitting the real estate market in St. Louis. It's really hard to figure this out at first glance. Some would say we're having a black swan event. We're going to spend first about a couple minutes acknowledging our 4 excellent panelists and giving you a little background on them. We have Jan Duke of Duke Homes, and I'm going to have Jan tell us a little about herself, and then I'll go on with the introductions.
Great. Well, thank you, Barry, for having us on your panel today. It's always a privilege to be here with the collaborative. Thank you for all your wonderful organization and great technology. I am a real estate entrepreneur and have been for 32 years and have done a little bit of everything real estate. So when I moved to St. Louis with my family in 2002, 18 years ago, I started in the high-end renovations in the Ladue Schools area, Frontenac, Creve Coeur, Ladue, Frontenac, that area, and have loved the high-end renovations. Those have worked out very well for us. I've also done a lot of lease options, hard money lending, and in the last couple years have been transitioning to more passive cash flow with the buying, fixing, and holding of rental houses, single family homes, especially some tiny homes that we're getting into most recently.
Excellent. Well, thank you. Our next panelist is Derek Grier. Derek is a real estate broker, investor, and also our state representative from the Chesterfield area. Welcome, Derek. Would you like to give us a little background on yourself, please?
Sure, happy to, Barry, and thanks so much for having me on this morning. So I've been in and around real estate most of my life. My family owns a property management company that does HOA management, so condos, villas, subdivisions. So worked with them for a number of years, and then transitioned into commercial. Worked with Cassidy Turley, which is now Cushman Wakefield, in their corporate services division. Had the opportunity to run one of their major accounts. So working on a national level with a client, I was in charge. My team was in charge of 1,600 locations, so acquisitions, dispositions, lease renewals, new site, that stuff. It was great experience, great way to learn about all different facets of real estate. And then a few years ago, I transitioned into residential brokerage and commercial brokerage, so I still do a little bit of both. And then also, I, as you mentioned, am a state representative from the 100th district, which covers half of Baldwin and half of Chesterfield. And all of Winchester, all 673 people, I think it is. And for the last 4 years, I've had the opportunity to do that. And before that, I was on the city council in Chesterfield. And right now, my main role and responsibility in the House is chairing the Economic Development Committee. So I spend a lot of time looking at business policy, a lot of time looking at ways that we can help encourage growth and stimulate job development here in the state.
Great. Wonderful background for what you're doing and for what we want to ask you. Our next panelist is Dustin Hogue, who is a realtor, investor, and hard money lender. Dustin, why don't you tell us a little bit about yourself, please?
Yeah, absolutely. Again, Barry, thank you for putting this together. Thank you for having me on. So I've had my real estate license for about 6 years now. Got into it what I thought was going to be part-time, ended up turning into an absolute passion and a career. Funny story, Dan actually helped me get into real estate full-time. Been an agent for about 4 years, and then I said I wanted to, instead of working for buyers and sellers, I wanted to be a buyer and seller. So became an investor in 2017, hit the ground running with that, have about 30 rental properties right now that I've acquired over the last 2 years, flip about 15 homes a year, and most recently joined the team at Faster Funds Lending as their loan officer to help other real estate investors in the St. Louis area either build a rental portfolio or rehab homes.
Wonderful. Thank you, Dustin. And last but by no means least, Bryan Schroeder, who is, I know, an appraiser, realtor, investor, hard money lender, but as an investor owns a lot of properties and went through the Great Recession and was standing comfortably afterwards. Why don't you tell us a little bit more about yourself, Bryan?
Pretty much summed it up there, Barry, but thanks for having me on. I became a real estate appraiser in 1994. Holy smokes, that was a long time ago. And I got my real estate broker's license back then too. So I've been a broker since 1995, I guess. Became a full-time real estate investor in 2002, started FasterHouse. Originally, we just bought houses, rehabbed them, and resold them. Kind of branched out into other related type things. We do have, and kind of similar but different than Jan, our niche has always been, I'm going to say, like the first time home buyer type house. So 100,000 to 250,000 maybe. That's always been our sweet spot price range wise. Every time I go into the high end market, I don't do well. So Dan's got that down and I don't.
She does.
But own single family rentals. All of my rentals are within 30 minutes of my office, which is in Newtown and St. Charles. So it pretty much means like Florissant, Hazelwood, Maryland Heights, Bridgeton, St. Charles, St. Peters, O'Fallon. That's where my rental portfolio is. I do own a hard money lending business, work with Dustin on that. And we have a little education business also, so a YouTube page, and we do some boot camps and webinars. So that's what we do.
So you manage quite a few rentals. Can we get just a rough idea of what you've got in your portfolio that you're managing?
I own 124. We don't manage for anybody else at this point. We've done it a little bit over the years, but we just don't enjoy it as much. So we own 124, just manage for ourselves.
Terrific. Well, thank you, panel, for introducing yourselves. Let's launch forth into our discussion for today, and let's talk about the short-term situation here in St. Louis. What's going on? And I define short-term as 1 to 3 months. What do we see ahead? What do we see going on right now? What's going on with the market? I'm going to ask Bryan to lead it off and tell us what you think's going on.
The market's hot right now in the I'm going to speak to what I know well, which is the 100 to 250, maybe 300 range. That market is hot right now in most areas of town. If you got a house, it's priced right. It typically sells in the first week at list price or above if you marked it right. And I suspect that's going to stay that way for the next few months because there's just so much. Interest rates are so low. I feel like there's pent up demand still from the spring market that didn't all get, the spring market didn't happen as it was supposed to happen. So some of it's shifting a little bit later into the summer. The market's hot. I suspect it's going to stay hot. It's hot for rentals too. Every time we have a rental property that we put up for rent, we have multiple applicants. Obviously, you got to sift through the applicants to find the best ones. But so the market, both on the retail side and the rental side, is really good. For investors, it's a little bit challenging to find good deals right now. But they're out there. You just got to look a little harder.
Okay. Jan, what do you tell us about the market that you're spanning a couple of markets, but the high-end market as well as your other comments?
Well, I certainly agree with Bryan. We have a strong market right now. I think everyone's been in quarantine and they're ready to get out and they're ready to go shopping, including for houses. That said, I think we need to be very cautious because I feel some of this is muscle memory from before the pandemic. And I think some of this is our strong seasonal market in St. Louis, which always carries us over in spring and early summer. With unemployment 13 to 14%, I think there's going to be people who can no longer afford their mortgages.
And they're on forbearance right now, aren't they?
Exactly, they're all in forbearance. So how many of those people are saving the money that they should be paying for rent? So when that forbearance lifts, they're going to be able to pay that 3, 4, 5 months of back payments or back rent. So I think we have an unofficial a challenge waiting to happen.
Yeah,
So
so we'll get into that in just a few minutes. One of the comments that I've picked up just yesterday from a real estate broker who does a lot of work in South County is that on 2 recent transactions that he was trying to buy for a client, that properties which were listed at 150 sold for about 180, which I don't know about you, but I wonder if that's not a bubble of some sort.
I think it is. We had 2 properties we put on the market last month, one in Town and Country, one in Creve Coeur. The one that I thought would be harder to sell in Town and Country went under contract right away. And I have 2 people in line wanting to purchase it as well.
Wow.
Whereas the Creve Coeur property, all brand new, everything priced at $389 is still on the market.
Isn't that
So
amazing?
just a very goofy, unpredictable market.
Right.
Anything goes right now. I don't think any of us have a clear crystal ball.
Derek, what do you think's going on? You're seeing it from a couple of different perspectives. I didn't realize I guess I remember it that you have a background in commercial, which is a whole nother subject we're going to get to later on another call. But what do you see going on from the real estate standpoint? And we'll talk later about how you think our government can help or not help.
Yeah, so I'll start with the residential side. I mean, if you look at all of the indicators show that the market is strong and it's going to continue to stay strong. We've got strong demand still, and that is driven by the low inventory that we have. So as long as we have low inventory, and we're at historic low inventory still, that's going to continue to drive demand and keep upward pressure on pricing. Some of the other factors that we have right now that we're looking at, I mean, interest rates, as Bryan mentioned, are at record lows. I don't see that changing anytime soon.
No.
The Fed has given indication is going to be changing.
We're in the short sale service business, my associate Rod Hamilton and I, and we're seeing a number of our clients decide to take the mortgage forbearance for the 3 months, and they don't want people coming through their house. In some cases, there's been a recent illness or operation in the hospital, and they're just basically putting the short sales on hold, which is part of, I think, what's pulling people are not listing as much right now. In some cases, correct me if I'm wrong, but I'm sensing that is exacerbating the demand.
Yeah, I think so. And one other factor too is with the whole COVID pandemic, a lot of people that live in apartments are now thinking, I don't really want to live in an apartment on top of all these other
Right.
people. Maybe it's time for me to get a house, be a first-time home buyer. So maybe, Bryan, you're going to see a lot more activity from people that have historically been comfortable in apartments and been happy kind of living in very close proximity to one another. I think that may change and continue to be another factor that drives in the residential side.
Great.
As you mentioned, commercial is a totally different beast.
Yep.
You know,
And that's a whole other subject that we need to defer because we could spend the whole call on just one aspect of commercial.
That's right.
So,
That's right.
so Dustin, tell us your perspective from a standpoint of someone who is now really a lender and also a buyer reseller and has also a realtor perspective.
Yeah,
Please.
absolutely. So, looking at everything that's been going on, and really let's back up for the last 2 weeks, we have started seeing investors probably confidence come back a little bit. We're getting a lot more loan requests than what we were, a month and a half ago to 2 months ago. Now we are hearing from a lot of investors that there's hard deals to find, or they're buying at a different formula. So where they might have been buying at 75% minus repairs, they've went down to 70% or 65%, because they don't know where the market's going to be. A lot of investors that we've been talking to as well on the lending side is they don't want big projects that are going to take 4 to 6 months because we really don't know where the market's going to be in 6 months.
Right.
If they can get in, get out, 3-week, 4-week job, hey, we have a little bit of an idea what that's going to do, but we don't know what's going to be happening in the future. So I believe the confidence is there. My confidence is there as a buyer. I have, started buying a little bit with a higher margin down to 70%, minus the repairs, of course. And I think the market I'm in, again, is kind of like what Bryan is, that first-time home buyer is what I like to buy as rentals. It's what I like to do as rehabs. I think that market's going to stay strong for a very long time. Last week, I was looking at the absorption rate just in St. Louis as a whole in different price points. And, once you get over that 350 mark, the days on market are going to be longer. And it always kind of has been in the St. Louis area. And that's stayed same for the last 6 months. So I think that's what we're going to continue to see. I believe personally, the first-time home buyer market is still going to be very strong, at least until most likely the end of the year.
Okay, well, let's move into a different time frame. Let's move into the 4 to 9 month, which I'll call intermediate time frame of the market. Now, I realize this is, kind of looking at the tea leaves and examining the tea leaves, but that's part of the fun of this, is we're going to ask you to sort of tell us what you think's going on. And now I've been reading a lot, as I'm sure you have, about how this recovery is going to be. If it's a V-shaped recovery, we could all be just carrying on without experiencing any serious dip. One of the major investment banking firms is talking about it being a V-shaped recovery unless there's a recurrence of the pandemic in the fall. Many others, though, are talking about it being a U-shaped, where the bottom of the U is extending out a little bit. And so we've got a potential, we talked about a 14% unemployment in St. Louis. And I have been watching over the last couple of months the number of major employers that we all rely on as being a solid, sort of underpinning to the St. Louis market. Companies like Mercy Hospital, BJC, and others that I'm sure you all can quote that have laid off or furloughed, in the thousands. So that is obviously hitting people's short-term ability. Hopefully they're getting some relief from the various governmental programs that are out there. But if we see an improvement of the unemployment rate, or of the unemployment getting to a 7 to 10%, which would be a good interim achievement, we're still going to be having a 7% unemployment. That's twice what the unemployment was going into this. And the other component that I think is hard to measure is the impact this has had on small businesses, on restaurants, meeting places, hotels, and all those people, some of whom are renters, but some of whom also might be people that are owning in that 100,000 to 250. So we're dodging the bullet right now. I guess the question is, what is that? If it's a U-shaped economic recovery, what does that do to the overall residential market? Realizing St. Louis is a lot less extreme in its history than, say, Phoenix or Seattle. So who would like to lead off on that?
I'll be happy to go.
Okay.
I think you hit the nail right on the head. We are not a volatile market. So in a good year, we may go up 2 to 4%, but the good news is in a bad year, we'll go down 2 to 4%. So we don't have an extra zero on the ends of these numbers. I had fun recently when I traveled back to St. Louis from California. I brought an ad for a fixer, and it was a real fixer. 2 bedroom, 1 bath. It looked like it maybe should have been torn down rather than renovated, but it was on sale for $1,395,000.
Where?
And I showed it to my team, and they thought, oh, this is so funny. What a typo. Oh my goodness. I had to tell them, no, that's not a typo. That's just an extra zero that we don't have on our prices that we do here in California. Now, those houses, those are going to go down 20% in a bad year. Easy. I've had it happen several times. But we're fortunate as real estate investors, as long as we stay small and nimble, we can steer that ship quickly and make adjustments and go to option B or option C. And hopefully every real estate investor is thinking of what those options are right now so that they're not pigeonholed into just one choice, and just be ready to move. Blessed are the flexible, for they shall
Right.
not be bent out of shape.
Uh,
I think
what I do want to throw in though is sort of a thought to consider is that before the last Great Recession in real estate happened, we had an appraiser, not you, Bryan, but somebody else say, St. Louis never really goes down very much in a down market, as Jan just stated. Well, that sure wasn't the case. Granted, it was a real estate driven and lending driven recession, but my goodness, those lower priced properties took a bath. And so I don't want to ignore that historical benchmark. So, Bryan, what do you think is going to happen in the 4 to 9 month?
I, I, I Barry and Jan, we went through that last recession, and so we remember it so clearly. But I'm I don't think we're going to have any big drops like we did during the last one, especially in those lower income properties like up in North County where those guys cut in half or more during the last downturn in 2008, 9, 10. I don't see that happening. And the reason is back then there was so much subprime mortgages out there. So there were a lot of people that had mortgages that probably shouldn't have. And what's taken the place of those is there's been so many investors that have bought in those areas, and they're not going away. And so I think there's going to be a floor on the market to a certain extent. And this time there's not a lot of bad loans out there, I don't believe. So I don't know. There's so many forces going on in the world right now. We always talk about, or the media and stuff talks about this V-shaped recovery or this U-shaped recovery. In real estate, and the economy is doing that for sure. And I don't know which one it is, a V or a U. I'm kind of more in the U camp than the V camp, but the stock market obviously V'd because the federal government pumped so freaking much money into the system that it just reinflated everything. But the real estate values, they obviously haven't dropped at all yet. So I don't think there's a V. I think it's more like a plateau. Right now, it's almost like a little bit of euphoria going on. And I suspect that's going to continue for the next 3 months. So if you're looking at the 4 to 9 months, I believe that euphoria is going to go away and it's going to kind of plateau for a little while. I don't know how long, because it's so hard to predict where interest rates are going to go. I suspect they're going to stay very low, which is good for the real estate market, and what the federal government does. And I suspect they're just going to keep printing money and giving money away, which is going to put a floor on the market. Sooner or later, that's got to manifest into something. I don't know what, but it's probably a couple years out. So I kind of see just this little euphoria going away and just kind of seeing a plateau for the winter. And
Sluggish market, maybe.
yeah, that's a good way to say it.
What do you think, Derek?
I am ever the optimist, Barry. Again, looking at the indicators, I don't see anything changing in residential real estate demand. I mean, I can see it continuing to increase, in fact. And supply, I don't see that changing either. One other factor that we haven't talked about is the whole work from home change and shift in the dynamic of the workforce that we may see. We're going to see a lot more employers allowing their employees the flexibility to work from home. So that means less people moving, less people having to transition from one market to another, perhaps. So that could drive down demand or drive up demand as well as we drive inventory down potentially. Also, if you look at some of the economic indicators right now, and people are reporting that they're feeling less concerned about their financial situation. So 12.6% right now, as opposed to 16% while we were going through the COVID. And that means like paying bills, they're more confident that they can pay their bills than they were before. And that 12.6% is about what it was before COVID hit. So people are feeling more confident about it. Now, a lot of that was because of the stimulus. And in fact, people right now, a statistic that I just read that was really interesting is that total personal income actually grew during the COVID crisis here. So people have 33% of their income in May compared to only 8% pre-pandemic that was available to them. So, I mean, I just don't see things in the 4 to 9 month range changing. Now, I will say that we have a big event coming up, right? Anytime there's an election, we've got a 4-year election cycle. Every time the economy just sort of stays steady right before that. Everything kind of freezes for a month or two ahead of an election because people are there's uncertainty, right? Anytime there's uncertainty, people just kind of take a freeze. And I would say maybe that trickles into the residential market as well. I mean, just real estate in general, that there's just kind of a hold and wait and let's see what happens and let's see what policies we're going to have coming out of potentially a new administration. I mean, I don't see much changing in 4 to 9 months.
Okay, Dustin, from your perspective, what do you think in 4 to 9 months?
Yeah, I kind of agree with Derek in regards to that it's going to be a lot of what happens in November. I think there's confidence with certain administrations and there's not going to be confidence in certain administrations. And with that being said, I think November is going to be big. I see a slower down in, October, November to see just what's happening. Like, hold on, let's see what's going to happen. And then, okay, now we have the election. Now we're going to decide which way we're going to go. It's going to be up, down, or stay the same. Personally, I think it's going to stay the same. Again, I don't think the interest rates are going to rise. So I think it's going to stay the same because of what the administration is going to do. And I think that's going to have the more confidence with the market. I think the first time home buyer market is going to stay extremely strong. We talked about the unemployment rate and a big company is laying off. My wife works for the biggest hospital in St. Louis at BJC. And most of her team, and she works from home, and most of her team was laid off, which is a very interesting thing because you figure in a medical pandemic, we're going to need the hospitals. That being said, they were laid off for about 2 weeks and now they're calling them all back. And now they can work 40 hours of overtime a week if they choose to. So it's an interesting dynamic that I don't think many people know what's going to happen. And they're kind of making decisions quickly and then realizing that probably wasn't the best decision they made. And I think that's going to happen a lot where the real estate is going to stay the same for them. I don't think there's any big decisions that are going to happen that are going to stay that way for long, where the real estate, industry is going to be that affected.
And your rehabbers, investors that you're financing, they are they any different in terms of their perspective on what they're doing, how quickly they want the projects to turn? Is there any change in perspective with them?
I would say yes. I mean, again, we don't we kind of coach them, and they're kind of on the agreement side of a 6-month project could be dangerous right now if you're buying really tight with your numbers. Especially if you're not in that first time home buyer range, if you're over that 250 market or in a luxury market, the city especially, they don't want to be in these big long-term projects right now because you don't know what's going to happen. So most people are wanting to get in, get out, and take advantage of this market right now. You know, like you said, there was a $150,000 house that they're selling at 180. People want to take advantage of that.
Right. Well, you know, let's move on into the 10 months and beyond, which I'll call long term. One of the things that keeps nagging at my thinking is that we have the key is going to be whether people who are the buyers are, whether they will have gotten back to work in enough volume to not have a drag on the market, and that certain parts of St. Louis, which are more moderately priced, could be affected negatively. And that's, I think, maybe where my concern comes in, is that if you have people who are on the margin, maybe in their kind of employment, you know, maybe there's 2 household incomes to get them qualified for a mortgage, and one of them is gone, and they're just like they're in maybe the restaurant sector or the hotel sector. They just haven't gotten an opportunity to go back to work because so many of the restaurants have been wiped out. Granted, there are always new restaurants that come along. It's a very vital industry, providing they can have enough people come into the restaurant. But I guess what I'm saying is that group may affect certain neighborhoods, certain types of suburbs that are, I would say, I would maybe characterize them as a transitional suburb, where, you know, it's sort of still a good suburb, but it's being, there's some issues that might cause the market to go negative. So I think, you know, I was asking someone the other day, well, what do you think about the economy rebounding? This is an economist, a retired economist. And surprisingly, his answer was, I don't think the economy will really rebound until there is a vaccine. And of course, there are a number of them that are really being fast-tracked, so that's good news. But I am not used to thinking that way, that we're relying on the economy being rescued by a vaccine. But there have been significant layoffs in St. Louis, unlike previous recessions. They've been fast. They're in segments or sectors I wouldn't have predicted, like the medical sector, the hospitals. And I'm just looking out farther. I'm saying, well, what about the long term? You've given us a pretty darn good report on what you think the intermediate term will be. I think it's going to be a sluggish market, but I don't think it's going to happen right away, because I think that there's still muscle memory, as you pointed out, Jan, a muscle memory demand from people that have been waiting to buy a house. They'll buy it with these interest rates being so low. But at some point, we're going to run out of those people, and all of a sudden, we're going to be into a sluggish market. So, you know, with that, unfortunately, a little negative perspective, give me some feedback on what you think the long term could look like. Derek?
Sure, I'll go. Again, ever the optimist. I don't see that we are going to have a decline. And I would disagree with the notion that the economy is not going to recover until there's a vaccine. I think and I don't know when that was that you talked to that individual, but the perception of people has changed. Consumers' perception and the public's perception of the risk and the danger of COVID, my sense is that has diminished significantly. And I do not believe that we would have another shutdown again unless the statistics and the data around the COVID changed dramatically. So unless we started to see the percentage and number of people infected, like as a whole, go up significantly, don't think that the public will stand shut down. I think the public sentiment just is not such that it would be supported, and a decision by officials to do that. I do not believe that public would get behind that and it would be possible again, unless the statistics change dramatically. The economy overall, I mean, before we went into the pandemic, people were already kind of feeling like, are we ever going to hit a ceiling? Like, surely there's got to be like a limit to how far this, how much continued growth we can get, right? It just keeps going up. So that's why I kind of feel like there is going to be a plateau, as Dustin mentioned. I mean, I think that we're going to maybe recover to where we were, and then we're just going to sit tight, and it's going to kind of level off for a little bit. And that's when I think there's going to be great opportunity, though, because that will cause friction in different markets. And I think, again, we're not going to get into a whole lot of detail here about commercial, but I do believe that there have been significant shifts in trends that are going to drive additional friction in like commercial markets, particularly B and C type properties, retail properties. People are not shopping as much as they used to. A lot of these small strip centers are going to start to suffer. And I think you're going to see a lot of those types of properties go into foreclosure. We're going to see some of that, and it's going to trickle into different areas as well. When you start to see that, it's going to affect other areas as well. So I personally am going to be looking for opportunities in the next 9 months, 12 months. I think there are going to be some things that shake loose, and I want to be ready to capitalize on those opportunities when they come.
Terrific. I like that. Bryan, what do you think in terms of long-term? Any further thoughts on what you've said?
Yeah, I'll just add a few thoughts. It's so hard to predict because there's so many different forces going on right now. But in general, I believe the single-family real estate market is going to do pretty well. And the primary reasons for that is I think we're going to be in an environment for a number of years where interest rates are very low, which always helps single-family houses. And I believe that, and I don't know, this is kind of maybe going in the weeds a little bit, but I believe that all the money that the federal government is pumping into the United States or the world is going to create inflation. And inflation, it might seem, I might be sounding a little backwards here by saying interest rates are going to stay low, which I truly believe they are, but I also think with all the money that's been pumped into the system, it's going to create inflation to go through the system, which is going to raise the value of real estate. So we may not have more buying power because there's more inflation going on, but people in the real estate market, values of houses, I believe, are going to continue to go up because everything's going to get more expensive. So low interest rates and inflation, which I don't know if it's possible, but that's my prediction long term, is good for the real estate market.
Would you go further and say that suburban and even farther out properties will be highly valued more so than, say, closer in properties?
In St. Louis, I believe that, yes, because in St. Louis, for the most part, we're a suburban city. So yes, I firmly believe that in St. Louis. I don't know if
Okay.
that's true in other markets, but here, yes, I believe that.
So Jan, I remember from the last crisis that one of your solutions to that time was to
Leave town.
to mothball your properties so that they were rented and occupied and cared for, and you took a trip around the world with your family, homeschooling your daughter, which has got to have been one of the wonderful sort of experiences in the midst of chaos. What were the factors that would be analytical factors that caused you to say, let's do it, as opposed to
Well,
sitting on the ground and battling with the problem?
that's a great question, Barry. I think I'd already been in the real estate market 20 years at that point, and I'd seen the cycles. If
Yeah,
there's anything I think we can all agree on, it is that real estate is cyclical.
right.
Trees are not designed to grow to the sky. They're always
That's true.
going to be pruned.
Yeah.
And fortunately, with real estate, unlike the stock market, I think we can usually sense when that's about to happen. Sometimes you have a few months notice, sometimes you have a year or two. I agree with what everyone's saying that interest rates are definitely going to help our real estate market because we have such great buying power right now. This couple we sold the town and country house to, they got a 15-year loan at 2.5%. That's free money.
That is
So
free money.
I do think that's going to help, but I think there is going to be some adjustments coming. So when we felt that happening during the '08 recession, we decided, why not think creatively? And so what we did is we took advantage of the 1031 tax exchange laws. We decided, let's sell high, buy low. So we sold a couple investment properties that were rental properties. And of course, it's a like exchange. So we bought a property in St. Louis that we could rent out for 1 year, 2 tax periods. And we then sold our big mansion house, 6,000 square foot house, and traveled around the world for a year. And it was priceless. Went to Mexico to learn Spanish for a month, went to Fiji, Australia, New Zealand, Hawaii, just kind of chased the warm weather with our 5th grade daughter. And it was priceless. And it was great. We came back, we moved into that house, and were able to then not have to pay taxes on any of that profit from those investment sales that we converted to our principal residence. And when we came back, everything was on sale.
Yeah. That's brilliant.
It
That's
was a
really,
great time to start fresh with new capital, and it worked out very well for us.
that was something that was very prescient, and you had so much fun as a family at the same time. And everybody has their own situation, has to decide what is the right thing to do. In your case, you were nimble enough that you could do that. Dustin, any further comments on the long term? I want to come back to Derek before we close this section out too. So, Dustin, anything further you want to add?
Yeah, I mean, not much. I kind of agree with what everyone's saying. It is, I was not in the industry when the last recession hit. So I don't have, just by me studying the market and what happened then, but I don't have personal experience with that. I will say that I believe the interest rates are going to be low. I do think values are going to rise. I don't know if they're going to go up as high as they have been for the last couple of years, but I do think that there's going to be on the incline still in the long term. And again, I'm going to say that a lot of it's going to be based off what happens in November. I think it's going to be a very interesting election.
Yep.
And I think either way, it could go either way at that point.
Good point. Derek, you also see this from the vantage point of your being a state representative and chairman of the Economic Development Committee. Tell us from the standpoint of the economic development of Missouri, particularly of St. Louis, are there policies being maintained or enacted that would help business? I know that's an awfully broad question, or affect our real estate market.
Yeah, sure. It's interesting because the way that I view government's role in situations like this and just the economy in general is that it is not the government's role to create jobs, but it is our role to create an environment that encourages job creation, that encourages entrepreneurship, that does as much to ease the burden of businesses while still having enough regulations to protect consumers as well. So at the state level, we're constantly looking at ways that we can ease the burden on businesses, on business owners, to drive additional job creation, allowing businesses to grow and to flourish. So there are a number of policies that we have enacted recently here, just in the last few months, that were specific to the pandemic that we're going through and to help with the situation, and that I think ultimately will drive additional interest in real estate and growth in the market. One of those in particular, well, I guess first, a number of executive orders have kind of highlighted some of the issues that we've been dealing with. Executive orders that have eased the ability for healthcare workers to go from state to state, easing telehealth restrictions that were there that really didn't make a whole lot of sense. Things like remote notary. In Missouri, we have not had the ability to do remote or online notarization. which makes no sense in the technology. With the technology that we have today, there is no reason why we should not enable that. Other states have done it. So that was another executive order that provided that ability to do remote notarization. Another area that I've spent a lot of time focusing in on is occupational licensing. We have 1 in 4 jobs now that is licensed that you have to get permission from the government to do. And often the requirements to get into those industries are burdensome, they're onerous, they're unnecessary. They don't really do anything to help drive the health, safety, and well-being of the public, which is why we have those licenses in the first place. This year, we were able to get a bill across the finish line that will allow for complete and total reciprocity with other states and occupational licenses, which means that Missouri is welcoming people, professionals that are established in their careers and understand how to operate within the industry they're in. We're encouraging those folks to come to Missouri and fill the jobs that we have here, because before the pandemic, the problem we had more than anything else was that we didn't have the skilled workers to fill the jobs that are there. So with this new law and policy change, we're going to allow more people to come to Missouri and more people to fill those jobs that we have, which is going to drive continued growth. So we're always, how can we make Missouri more attractive? We lowered the corporate tax rate a year ago, which also encourages investment in Missouri. We've got an organization, the Missouri Partnership, whose entire job it is to go out and promote Missouri to the rest of the world. And they have incredible leadership there, and they're going out and they're to, going to China, going to India, going to all these other countries and saying, hey, you should come to Missouri because we've got a lot of good things and we've got an environment that supports business and job creation. So yes, I think that those things are going to continue as long as the makeup and dynamic of the House and the Senate don't change, and we don't have any major shifts in that. Again, before an election, there's always a pause because if there was a shift and a change and the election changed stuff, then those policies might be different and there might not be the same outlook.
Right. Excellent, Derek. Those are all really great comments. I have 2 more areas I want to quickly discuss. One is, it's really almost a personal thing, but if you're an active investor in real estate, do you have any sense of what kind of liquidity you would encourage people to maintain? Jan?
I always tell people they should have a minimum of 4 to 6 months of living expenses liquid. So no matter what you're investing in, you gotta make sure that you've got liquid funds to live on. I was surprised to learn recently that 92% of Americans don't have 3 months of living expenses saved. 92%. That's just wrong. That's why we're looking to the government to keep people afloat.
Right.
We need to do a better job. So I'm all about getting out of debt first.
Right.
And what we've been doing is using our self-directed IRAs, specifically our Roth IRAs, so that we can invest tax-free in
Right.
our projects. So with our renovations as well as our rental properties, we have no loans on any of those projects.
Wow.
It almost gives me an unfair advantage because
It does.
20 to 30% that I'm not paying in taxes that other investors are paying, that's straight profit.
Right.
So I just think it's hugely advantageous to just be extremely cautious, especially in these times. We've all
Right.
talked about how the pause button is being pressed. If nothing else, I think we all agree that the pause button is our fingers on the pause button. I'm probably the most conservative investor that you'll meet. In the hundreds of transactions that I've been involved in real estate, I've never lost a dime on one of them. And so I'm extremely cautious. And
Well, that's
I just,
good. I know you're a good buyer, and it's all in the buying, isn't it?
all in the buy. I celebrate my purchases more than my
Right.
sales because
So
you
Bryan,
make money on the
thank,
purchase, not on the
yes,
sale.
thank you, Jan. Bryan, what kind of liquidity would you advise people to, if they're actively out there as real estate entrepreneurs? Of course, where they're getting their cash flow from is important, but what about liquidity that's sort of rainy day money? What would you recommend?
Yeah, first of all, before I answer that, I'm going to say I'm going to vote for Derek. I wish I was in his district. The dude is passionate about Missouri. I love that.
Yes,
Holy
love it
smokes.
too.
Derek's doing
You can give to
fabulous
his
things.
you can give to his
Thank you.
campaign, Brian. We'll put you on the list.
All right, I'll
Yeah,
do it.
right.
Let me know.
I will shamelessly promote myself.
All right, good.
We will
I
too,
like,
Derek.
I love people that are passionate about Missouri and have great ideas. That's awesome.
Yeah.
But yeah, I pretty much agree with what Janet said, or Jan said. You know, you got to have at least 4 to 6 months of reserves if you're a real estate investor, for sure. And then that's personal reserves for you to live on, because you just never know what's gonna happen when you have a project or if you got rental houses. But then, you know, in the rental game, you know, I got some. Uh, I don't know, formulas, I guess you would say, for how much reserves to keep per house you have and stuff like that. But I would just say in general, I feel like we are a little bit in an unknown time, because there's just, you keep saying this, there's so many different forces going on between the virus and a vaccine and all the money that the government's pumping into things. And there's just so many unknowns. So I would say that just it's good to have more liquidity than you in a normal time. I would say that.
Okay.
And I'd also say that there, you don't necessarily just have to have that just as cash sitting in a bank either. You can, if you got good rental houses, or that you can have a line of credit against or something. So just so you have access to cash is what I would make sure is
Okay.
have access to cash in some form or
Okay,
fashion.
great. Dustin?
Yep. So I agree with the 4 to 6 months. I mean, kind of going off the, if you will, the Dave Ramsey philosophy, when, you know, let's get out of the bad debt first. Let's also watch the expenses. And I think that's something that, you know, my wife and I did. We heard about the pandemic. Hey, what can we cut if we need to be cut? And then we realized we're spending a lot of money that we shouldn't have been spending on stuff that we probably forgot about anyway. Right. So I hope a lot of people did that exercise. And if you didn't, I would urge you to. And then the 4 to 6 months personal, you know, as the lender side, we always want to make sure that we're approving borrowers with reserves. We want to make it a win-win situation with the team here. We are all investors, and things go wrong when you're working on a house. So you need to have some reserves to take care of that. So we want to make
Right.
sure that they're liquid for that as well. And then, like Brian said, make sure that you have access to cash
Okay,
when those things do go wrong.
great, Dustin. Derek?
My philosophy is I like to have a third highly liquid, a third invested in undervalued assets, and a third in income producing properties. So, you know, your A-type properties that are going to be solid investments for the long term. Right
Perfect.
now, I will tell you, I've gone beyond the 4 to 6 months of personal income or expenses available. I'm probably at like 12 to 14 months right now. And it's not because I'm afraid of what's going to happen. It's more out of wanting to be ready to capitalize on opportunities. I just feel like there's going to be an opportunity for something. I'm not sure what yet, where it's going to be, but I have been kind of stockpiling our cash and making sure that we're watching our expenses so that we can do that and be ready to execute when we see the opportunities.
Okay, great. I had put a question in our discussion points about how would you invest $10 million if your rich Uncle Louis died, or you just happen to have $10 million. And I don't want to take a lot of time on this. If you can just kind of be brief on your response, and then we'll have time, I think, for a few questions and answers. So, Dustin, how would you invest $10 million?
I would probably say just easily $2 million would go towards the A properties, the A-class properties that I know are going to appreciate, that have some cash flow coming in. I would probably invest $2 million on even the C to D property, where the cash flow is absolutely huge, but you're not getting much appreciation there at all. I would also take some of that money and lend it out. Becoming a lender, I've learned pretty good things about that, and I think that's a great way to make money on your money. So that's probably what I would do with the rest. And then I'm sure my wife would want something new. So that's probably what I would invest in the rest.
Brian, what would you do with $10 million?
I would probably do. I love what Dustin said about the lending. I wasn't thinking about that. But if I had $10 million cash, I'd probably put 80% of it in cash flowing single family rentals or a small apartment buildings. I love owning assets that pay you to own them. So I would invest heavily in that area. The second thing that I would do is do something to diversify away from that, which would probably be the stock market. You know, it's bet on America. America's a great company, so just invest in some index funds in the stock market. And the third thing I would do is I would invest 10% of that in gold or precious metals, because I don't know what the heck's going to happen with the world. So you got to have a little bit of an insurance policy there. Precious metals are the insurance policy for inflation or the federal government doing something stupid to our monetary policy.
Okay. Derek? Oh, if I asked
Well,
you that? No, I haven't. Go ahead.
I would invest in a broadly diversified mix of public and private American businesses. I would say that that would probably include stocks and real estate. I would want to be benefiting from the most powerful juggernaut in the world, which is American capitalism.
Okay. Jan, what would you do with $10 million?
First thing I would do is give away the first million, 10%.
Okay.
Have a ton of fun with that.
That'd be
And then
good.
I would take another million, 10%, and keep it extremely liquid.
Okay.
And then with the other 80%, I would invest it in single family homes because it's what I know, it's what I love, and I think they're fun.
Would you go all cash?
All cash,
No debt.
absolutely.
No debt on the houses.
Not leverage any of my investments.
How
All
about
cash.
you, Brian? Would you go all cash on the houses that you would buy?
In the way, I'll just tell you what I do now. What I do now is I do 40% leverage, because I feel 40% leverage is very safe from any kind of craziness that happens, but it also gives you a little bit of extra return because you have that leverage. Because leverage is so freaking cheap right now. If we're at 8% interest rates, I would probably do what Jan's doing. But when you can get interest rates at 3% or 4%, I use it. So I go 40% leverage.
And I
Okay.
think Brian's wise to do that, Barry. I just want to clarify, Brian's at a different stage of his career than I am. So I'm looking for less management and more profit. So it's just easier for me to not have the leverage. But I think what Brian's doing with money being so cheap, it's very wise for him at this point in his career.
Yeah, I ran into someone who owned 200 rental properties in North County a year ago, and they were all cash. So, if there's issues with those properties, which there often historically have been, with any rental really, you're almost self-insuring with no debt to worry about. You can cover your taxes and insurance and repairs and still do very, very well. So the idea of all cash as you build long-term towards that is very good. And of course, Jan, I love the fact that you're doing it through your Roth and your self-directed retirement plans. That's something that most real estate investors should aspire to.
Thank you. It's been a huge factor in our success is using the tax-free profit. And it was at the last recession where we converted all our traditional IRAs to Roth IRAs. Because when your assets are valued at the lowest point, that's when you want to pay taxes on them. Do the conversion, tax the seed, not the fruit, and then watch those assets grow. And then you can take them out tax-free with absolutely no taxes in the future.
Very smart. Dan, do we have any questions and answers that have come in that need to be looked at?
Yes, so David Randolph asks, how many millennials that are maybe living with parents, maybe even since the 2009 back in the day, how's the demand going to be for them getting out and buying their own houses? And if there'll be a good demand, how long will that demand last?
Well, there's certainly going to be those millennials wanting to move out, but there's also a lot of millennials wanting to move back in as their jobs become more precarious and life is more uncertain. So there may be a wash there.
Anybody else want to comment on that?
Yeah, I mean, I think we're in an environment right now where we have these two big demographic forces. You got all the baby boomers that are retiring, starting to pass away, honestly, moving into senior centers. So you got all those homes becoming vacant. They quite often haven't been updated for many years. And then you got this big demographic of the millennials coming up that is replacing that. And hopefully it's a bigger demographic than the one that's going away. And I think it is. So I think I love millennials. You know, I think millennials get a bad rap. I don't know about you guys, but I have a company that's full of millennials, and they are freaking awesome.
Great.
Thank you, Brian. I am the first year. I was born in '81, so I am the first of the millennials.
Hey, Derek. Well, you're a great example of a millennial. That's right.
Yep.
Dan, anything else in the question and answer? We're at the top of the hour here.
What do you guys think about the low money and no money down loans that are out there on houses these days?
Are there any?
Absolutely. They're coming back, unfortunately, because they definitely hurt our market in the long term.
My standpoint is in the short sale business, I think that is what's beginning to happen in the short sales, that people have bought with 96.5% financing or 100%, and then either through illness or through loss of job, they are in trouble. Or it doesn't take more than 5% drop in the value, which isn't a whole lot, and all of a sudden they're going, wait a minute, I'm underwater after I pay a commission and closing costs, and they have to do a short sale. So I don't have a great deal of I don't feel it's particularly a good way to finance. It gets people into homes, but good grief, it sure invites problems for some.
I've been very surprised the last few homes that I have sold and been a part of the transaction in, that they have been really low down payments. So 98%, I'm seeing on the contract coming back that's what they're adding as the loan contingency.
Wow.
Surprised that there are as many happening as there are. And I don't think it's a good thing either.
Yeah.
Yeah, I agree with that. I got into the mortgage industry actually in 2009 and kind of saw the after effects of the recession.
Right.
And I do believe that the low down payments mortgages out there now have a lot more restrictions than they did in the past. I worked at mortgage shops where they were making W-2s for people. And I don't think that's happening like it was into that area, which I think that's protecting us a little bit. However, I think they have to have some skin in the game. Let me just put it that way.
Right.
They need to have some skin in the game because you're going to appreciate more. You're not just going to walk away from it like they were doing. So that's my opinion on it.
Great. Anybody have a burning desire to make a statement or anything further? Otherwise, we can call ourselves to a close. And I do thank our panelists, Jan, Dustin, Brian, and Derek, for bringing their unique vantage points to our panel this morning. Dan Lewig, thank you so much for being the managing host with such efficiency. Thank you to our sponsors for making these the Real Estate Collaborative meetings possible. We're hoping to get back to a live in-person meeting, maybe by late September. We have a date scheduled in late September and a date scheduled in early December. We'll just see what the marketplace is and the Pear Lodge, but we're also prepared to continue the online version. And we want to thank all of our attendees for joining us this morning. And if you have any questions or comments, feel free to send me an email at barry@mpastl.com and go to our website, www.therealestatecollaborative.com. Within the next week, we should have this webinar posted as a recording, and I think it's an MP4 format, so you can listen to it. Again, thank you all for being with us, panelists, attendees, sponsors. It's been great, and we'll look forward to the next one, which is scheduled for July the 9th. Thanks, and goodbye, everybody.
Thank you, Barry.
Thank you.
Well done. Thank you.
Thank you. Bye-bye.